All right, we have about 30 seconds until we get things underway after our little streaming hiatus. We are going to get back into it very shortly here. All right, 10 seconds to go. And if we get it, we've got we've only got a couple viewers right now. I definitely could have done a little bit better of a job of advertising this for sure. However, if we get up to if we hit 30 viewers at any time during the stream, I think we'll flip on the where is it? The little HT giveaway. And for those of you who have previously won the HT giveaway, we are getting those shipped out this week. I finally got all the addresses compiled. We're getting those shipped out. So thank you for your patience and not completely bugging me while you've been waiting on those. But the timer is up. Let's get into it. Thank you for those of you who are tuning in, and welcome back to our weekly stock market scan. And last week was a great week in the market for us as we took home a profit of just under $18,000, which was, obviously that's objectively incredible for us. But, we really, really needed it because if you look at that year-to-date summary tab that we're going to try to pull up right here, you'll see that it still doesn't quite cover what we lost 2 weeks ago, when we lost about $20,000. But, it's a marathon. It's not a sprint. The market has been all over the place so far this year. And as of market close on Friday, the S&P 500 was down 7.83% on the year. So that is pretty significant in just 2 short months to be down that much money on the year. One of those things where, especially with this chart, we've seen how quickly our account can rebound when the market does. And I can guarantee you that this type of a decrease in the market is 7.83%, is not something that's going to be made up super quickly from the S&P 500 perspective. But for us right here, look, we went from 21% loss to 11% loss. So we can absolutely outpace the S&P 500 if and when we decide to rebound. So that is the plan. That is what we're working on. And that is what we are hoping happens in these coming weeks. And again, we're down, 16,000, a little bit more than that on the year so far. We're not going to get it all back in 1 week. We're going to keep sticking to what got us here, a nice, smart, disciplined approach where we compound our gains and eventually get back even. And again, it's one of those things where it sucks that we're losing money, but you've got to take a step back and understand the bigger picture in the market, which is that the market is down a ton. And I've always said that we could lose money in a year, but as long as our return is better than the return in the S&P 500, I consider us to be winners. So with that said, let's do a quick recap of last week. And I want to spend a lot more time on this stream getting into what we're doing for the upcoming week in the stock market. So with that said, last week, some big winners with Affirm, Roblox, and DraftKings especially, which bounced from 17.29 back up to 21.64. For that big red week we had, we lost, it looks like $12,000 on that one, went from 23 down to 17. And we recouped a little bit of that. But the good thing that we did was, the week prior was we sold 24.5 covered calls. So we at least recouped about 2,400 of it right there. And then for last week, I didn't really think these would ever come into play, but we sold these 21 strike calls when it was trading at about 1850-ish, and that number got hit. So we did incur a little bit of a loss on those covered calls. But when we sell covered calls on stocks, we always want to remember that we're trying to sell them at a strike where if it gets back up there, we're perfectly happy with that. And the fact that we took a $420 loss on these covered calls right here is really just due to the fact that this went up so high. So without this 8,700 gain, there is no 420 loss. So we're okay with the little bit of red right here because the way that we treat covered calls is very similar to how we treat cash secured puts. When cash secured puts lose a little bit of money for us, we want to roll them down and out to lower strikes and further dates. When covered calls get in the money, we want to roll them up and out. But actually, here's what we did with DraftKings. I think it's definitely something that's worth discussing as far as position management is concerned, right? So here are those 24.5 strike calls that we saw for 2 weeks ago. Here's last week's trade where we sold them for 41 cents. That we closed them out for 64 cents. That's a $460 loss that we looked at on the last tab. 43. I guess we sold them for a little more than that. I think this might be wrong. However, regardless, $400 and something loss right here. But here's what we can do, right? We know that this $460 loss really is kind of temporary. So what we've done is we have rolled to the same strike, but for a large credit. And the credit that we get, remember, is the difference between the debit that we closed the previous one for and the credit we receive when we open up the new position. And I've got to give a shout out to SK in the YouTube chat and Cash for tuning in and lighting up the chat first. What's going on, guys? Thanks for joining in with us on this Sunday night. But talking through that DraftKings management strategy again, going into last week, we had a 23.28 break-even price, which objectively, that's fantastic because we started playing this thing at the end of November when the stock was at 36, and now we're in a position where it's just as long as it rebounds up to this 23.28, which is now 22.48 level, we're going to break even on that trade. And that is something that is phenomenal, all things considered, right? Because these cash secured puts that we enter into, these are bullish positions. So if we have a bullish position that drops 38% on us and we're still at the end of the day looking at potentially breaking even, or we're being close to breaking even despite that big drop, that is a huge testament to the effectiveness of the strategy that we're running in here. So that's what we did, right? We know that when we roll covered calls or roll cash secured puts for that matter, if we're rolling at the same strike, the credit that we get is the decrease to our break-even price. So we got an 80-cent credit, meaning that we sold the new covered calls for 80 cents more than we closed them for, and that's a direct reduction to the break-even price. So our break-even price this week has gone from 23.28 to now on 2.25 last Friday when we managed this position. We now have a 22.48 break-even price, and we know that since we sold 21 strike covered calls, we can't really break even because our shares will get called away at 21 as opposed to 22.48. However, especially with how shaky the market has been, we really want to make sure we're getting the biggest credits that we can, because the bigger the credit, the bigger the cushion, and the bigger the cushion, the more easily you're going to be able to navigate these really, really shaky markets that we're trading in right now. So that's kind of the focus. We really want to focus on that downside protection because, if DraftKings runs back down to 16 and all of a sudden we're stuck with like a 23, 24 break-even price, we're going to regret not being a little bit more conservative. Now, the flip side of that, obviously, in the game that we play here, is that if DraftKings runs up to 25 by next Friday, we're going to say, oh, crap, we could have sold a higher covered call strike and we would have broken even. But with how crazy things have been, we've already seen futures. They're down, I think, 2% right now, and it's only Sunday night heading into the week. We want to be protected against any big red swings in the market because we've seen big green, we've seen a lot of big red. And, typically after big green days, you'll see big red days. That's just the way things go up and down and up and down. But we just want to sit back, ride the waves. And the best way to do that is by managing that break-even price to get it as low as possible. So that's why we did that. We rolled the in-the-money covered calls, lowered our break-even price by 80 more cents. And let's say DraftKings hangs around this similar number next week. We may be able to say, okay, let's sell 22 strike covered calls for maybe 50 cents. And then we are finally in a position where that would decrease our break-even price by 50 cents. It would get our call strike up to 22, and then we could break even at 22. But again, patience is so important with this strategy because as you could see, it did look pretty bleak at one point. This was over $10,000 loss at one point when it really, really was down, I think over 50% on us at one point. But, we stick to the strategy. We trust the process that we've laid out. We keep chipping away at the break-even price, and eventually, right, this break-even price, we can make it go lower every single week. The stock isn't going to go down every single week. So we hang in there, we take advantage of the option premium, and we keep driving it down. So that's what we did with DraftKings. That's really the only big one that I wanted to point out. Fubo, we're still following the same process here. We started playing this thing at 17.5. It's down to 8.14, which again, significant drop at 53%. But the fact that, hey, we've got an 11.55 break-even price, we're still kind of in the game, relatively speaking, right? If you go a month back in time, we were $1 higher. If you go a month back before that, we were, a couple dollars higher. So really, we're not going to $1.50 off this thing a month, and that's exactly what we're going to keep trying to do. So by the end of March, maybe we'll have a close to $10 break-even price, and if Fubo's still hanging around here, or if Fubo has rebounded up to 10, we could potentially break even. So you just stay patient. Keep managing the break-even price. And this is another one where I think I do have the capacity to double down at some point, which brings up the discussion, when do I want to double down? Because it's really, really tough. And I think one of the big mistakes that we've made, and I've talked about this a little bit in the Discord server, is that we've doubled down and entered into our coverage strangles a little bit too quickly, right? You could see that we entered into our coverage strangle. When did we enter into our coverage strangle here? It looks like January 21st. So I guess we were a little bit patient in the sense that we waited till January 21st when we entered into the coverage strangle. Actually, it looks like the coverage strangle was on the 7th. We entered into it, and we just kept rolling the strikes. But again, we started that trade on December 23rd, and we were into a coverage strangle, aka doubling down on the position by January 7th. I think we need to, in the future, be a little bit more patient because doubling down is so effective. And again, you don't want to keep doubling down to infinity and put yourself in a position with unnecessary amount of risk. But with a 2,000 position size, this is roughly 16K position size. It's about 10% of our account, so we could potentially afford to increase that position a little bit further. But let me quickly demonstrate how effective doubling down can be here, right? Because we have shares. Essentially, we have 2,000 shares right now, 1,000 here, 1,000 there at an 11.55 break-even price. Now, if we wanted to double down, what we could do is sell 8-strike puts. And let's say that those 8-strike puts were going for, 30 cents this week. So we'd have an 11.55 break-even price. You'd subtract covered call premium, which would be minus 0.23. And then you'd subtract maybe 30 cents of premium on the 8-strike puts. So if it stays above 8, we know that we're going to get both of those premiums, and that really effectively lowers our break-even price, right? We're going to knock 50 cents off that break-even price in just 1 week. And if you keep up a pace like that, you are going to get to a 0 break-even price in just 22 weeks, which is, insane. But that kind of illustrates how effective doubling down is. But here's the real kicker, right? We could theoretically have this break-even price if it hung above 8, but what if we got assigned those shares at 8? And if we sold 8-strike puts for 30 cents of premium, we know that the basis in those assigned shares is going to be 7.7. So that's going to be half of our shares are going to be at a basis of 7.7, while the other half are going to have this basis of 11.55. So 11.55 plus 7.7 divided by 2 now gives you an average break-even, or gives you an average basis in your shares of $9.62. And now you're going to have an increased position there. But the fact that you could potentially drop this entire break-even price by about $2, which is roughly 20% just from doubling down with the 8-strike put, that is where you start to really effectively take a chunk out of that break-even price. And I think we've seen a lot of really tough decreases, right? This one's dropped 53% on us in 8 weeks, it looks like, which is an insane drop, right? These are not normal market conditions, but again, this is the reality of trading. These are the market conditions that we need to make sure our strategy can effectively combat. And that's exactly what this kind of outlook with this coverage strangle strategy accomplishes. But again, if I had waited a little bit longer, right, when I initially did it on the 7th of January, I could have waited a little bit longer, and when FUBO was down at 10 or 11 a share, and then doubled down, and I much more effectively would have managed the downside on my break-even price. I admittedly, and I think it's really important to kind of have the honest dialogue about things that we've done wrong as well as what we've done correctly. And I think what I did wrong was looking at this trade saying, okay, maybe back when FUBO was trading at 14 a share after we jumped in at 17.5 and say, okay, this thing's down 20% in 2 weeks. That's a really big drop. I'm going to double down. But I think things can always get worse, and that's definitely something that we like to emphasize in our Discord server when we talk about our approach to trades. It can always get worse. And I think that downside, just some awareness of that downside is something we could do a little bit better in timing that coverage strangle. But Palantir, little segue right there for the coverage strangle. Another example, we're a lot further away from breaking even here, but again, we started this one in November at 24.8. We now have a break-even price of 17.98, and this is one where that average price consideration when you double down is really effective, right? Because we could take it from a 17.98 break-even price, and Palantir is trading at 11.47 as of market close on Friday. Presumably going to be a little bit lower on Monday because futures are down. However, let's say that we sold 11-strike puts on Palantir. And let's pull this calculator back up again, right? And if those 11-strike puts were similarly going for something like 30 cents of premium, that's just a hypothetical, and we were assigned to actually fully double down again on that position, that new chunk of shares would have a basis of 10.7. And when you combine that with the old chunk of shares that had a basis of 17.98, and we divide that by 2 to give us the average, our new break-even price would be $14.34. So this is a situation where it would be super, super effective to double down again via coverage strangle, provided you're still bullish on the stock, right? If you think this thing's going to zero, there's no need to be in this trade at all. But with how far it's fallen, the fact that they generate some solid revenues, they were kind of trading at a pretty rich multiple previously, but it's one of those where I think, between the stock having okay fundamentals and a little bit of a fan club, one that I'm perfectly happy to keep playing at these prices. But again, doubling down with like an 11 strike put and then getting a sign on that will potentially get us down to a 14.34 break-even price. And then what's fun from there is if you really want to be hands-off, and we're jumping into Thinkorswim for the first time here tonight, if we type in Palantir right here, and if we had that hypothetical, let me see, where is the calculator icon? There it is. So if we had this hypothetical 14.34 break-even price on assigned shares, and we said, you know what, this has been a lot, the market's moving up, the market's moving down, I just want to be hands-off, let's sell something for June. And you could sell something like a 12 or a 13 strike covered call for $1.18. And if we subtract $1.18, all of a sudden you've gone from having a break-even price of $17.98, and within 1 week with getting assigned on that and then just selling something far out like to the summer to say hands off, you now have a $13.16 break-even price. So that's a really good example of how we can use these premiums and kind of manage the positions on a week-to-week basis. And do we scale in? Do we scale out? Do we increase, decrease position size? These are kind of the considerations I look for and how effectively you could lower that break-even price, right? And if we did hypothetically do that, and I'm not going to do it, but if we did hypothetically do that and get ourselves down to that 13.16 break-even price, right, we would be looking at a trade where from November to June, we started on a stock that we liked at 24.8 and now have a basis of 13.16. That is incredibly effective, and that's only really 6 months of option premium working for you. If getting back to the point of the stock market being a marathon and not a sprint, if you kind of compound this and maybe you have to stay in the trade for a year and you could knock another $6 off it over the next 6 months, all of a sudden you have a $7 basis in Palantir, which is incredibly attractive. And it's really why these strategies that we're running in here are so advantageous and a great long-term investing strategy. Excuse me. And we see a lot of different, I emphasize long-term investing strategy because we see a lot of different investing strategies where, it's kind of a flash in the pan. People are buying puts on the market and it tanks and they're like, look at me, I turned $1,000 into $10,000. And, that's great. I'm not discounting the fact that those types of opportunities might be available in the market right now. But personally, I don't know about you, but I know about me personally, I plan on trading a little bit longer than just the entirety of maybe the Russia-Ukraine conflict, and I want to have a 5, 10, 15 plus year approach to the market. And with that, we're going to need a strategy that sets us up for long-term success, and that is exactly what this type of thing does. And again, the example I like to pull up on the stream is we did the same thing with GHIV, which became UWMC. We didn't have the break-even price tracker on this one as effectively broken out as we did before. And, this trade was a big reason why we did start that break-even price tracker. But by the end of it, right, this thing started at 1084. By the end of it, we ended up having a 339 break-even price. And that was on something that we started in December of 2020 and wrapped up by June of 2021. So like a 6-7 month trade, but we ended up making 5 figures on it. And again, these are bullish positions. The stock dropped 12% while we were in on it, yet we still made an $11,209 return on it. And again, that's 49% return on the capital that we had invested. That is over 100% annualized return. And that is again on a stock that dropped on us. So that is how effective this is. And it's a lot easier for me to sit here and say these things to you like be patient, because quite frankly, I've sat here and I've done this before as we've illustrated with something like this. If you're newer to this strategy, maybe even newer to the stock market, don't get me wrong, it can be very, very intimidating, especially for something like the Palantir trade, right? We look at our position and we're sitting on a $13,000 loss on the Palantir trade. That's never a fun number to open up your brokerage account and look at. But again, we have examples like GHIV, which we previously had something like a $3,000, really a $4,000 loss off the bat. This one was a little bit different because it didn't move as sharply against us. But again, this thing turned into 5 figures of profit. We've got something like DraftKings, which when the stock was trading at about $16 a share, we were looking at a similar loss, right? Another $13,000 plus loss because we didn't have the benefit of these premiums sold yet. But again, some of these trades can get to a point where they look pretty dark. But again, the thing about the stock market, stocks go up, stocks go down. And even if stocks go down, it's typically not going to be in a straight line, which is why this strategy gives us opportunities to lower our break-even price, catch bounces, average down. It really, really is flexible and a great way to trade in a volatile market. So that's where we're at. And again, I think I'm guilty again of saying we were going to have a quick recap and then got into, rambling on a little bit about some of the core positions we're in, but definitely important to talk about. But let's turn our focus, because I know a lot of you guys watching right now have some decent amount of buying power, because that was something we emphasized so heavily in the Discord on Friday is, look, we had a great week. Let's not get too aggressive here. Let's not find ourselves repeating what we did 2 weeks ago when we lost $20,000, and maybe repeating what happened in the front end of January, which got us in this hole in the first place. And let's just, objectively try to make the best, most conservative, compounding, consistent trades we can, so that even though we're down money right now, let's take a look back to 2021 and get back to what we did in that year when we didn't lose a single month on the year. So that's why we're confident that we're going to be able to get this money back, right? If you look at the entirety of 2021, the average profit per month was about $7,800. So if we get back to that, which, there's never a guarantee, but, it would take roughly 2 months to get back break even. And I think it's going to take the S&P 500 a little bit longer than 2 months to get back up to the 474 that it started the year off at. So perfectly happy with where we're at. Obviously, I'd love to be profitable, but all things considered, having such large positions in things like Roblox, where the stock has moved down considerably against us, Palantir, we talked about DraftKings, Fubo, things like Affirm, where the stock has moved down so significantly against us. The fact that we're still even in the game right now on a lot of these, and closing on and outperforming, and then having the potential to get back to break even, I think is really, really encouraging. So we're going to keep that up and not try to do anything too stupid. I feel like that DraftKings bounce last week in a way was a huge gift to get us just back in the game, back under a 10% loss on the year. And hopefully we can move forward from that. So here's what we have set up for the upcoming week. Palantir we talked about. We're just kind of playing the game of trying to chip away week by week by week at that break-even price. And sometimes that's going to require you selling strikes that are closer to the money, and just that trade-off of premium for capping your stock price is one that you're going to have to make. And when the stock has moved this far against you, right? Because we have a 17.98 break-even price. Selling a covered call at 12 strike is still pretty far away from where we need to be. But again, we got 21 cents for this covered call, right? And if we run through that train of thought where we say, hey, if we get 20 cents of premium per week on this thing, and there's 52 weeks in a year, I mean, this is really extrapolating it here, but there's 52 weeks in a year and we get 20 cents of premium per week, over the course of a year, we're going to knock $10 off the break-even price on this thing. So that's kind of what I'm targeting on a week-to-week basis, right? Because we sell options with expiry dates, but the great news about the strategy that we run is once these have expired, we collect our profit, we just sell it again for next week. So there's not some finite timeline for any of these trades. We can infinitely decrease that break-even price, and that's kind of the thought process that we want to look at as we try to figure out what strikes to sell. So Affirm, we still have these 50 strike puts. This is kind of, I think if I had to evaluate risk of positions right here, this is probably our riskiest one because it's kind of the largest one right now. And we're really stuck with what's kind of like a glorified position in shares. So we sold 50 strike puts and we managed this position as much as we could manage it, right? Again, this is one where the stock was at 81.03 when we started trading it. And our initial break-even price was 52.23 for what was going to be a 2-month trade. And we managed the trade a little bit and got it to the point where we got our break-even down to 48.46, which, still objectively I think is really, really nice because in plain English, we set ourselves up with a trade where, hey, as long as the stock doesn't drop 40% in a month, we're going to make money. And unfortunately, it's down 51.64%. But again, to the point we were making a second ago, there's nothing that's stopping us from taking that 48.46 break-even price that we have coming due in a few weeks, rolling something out to April maybe, and then just chipping away at this. And same idea here with the Roblox trade, right? We ended up cutting the position in half to reduce risk a little bit. And this is one of those things where it sucks because, yeah, you lock in, so to speak, a $4,800 loss right there. But in exchange, you definitely reduce the amount of risk that you're in. And we could do exactly what we did, where eventually after Roblox dropped a little bit, we scaled back into it by reopening that closed position with a lower strike, and that allows us to collect a little bit more premium on a week-to-week basis, right? And this actually turned out very, very well for us because, for example, you'll notice the 70 strike put that we sold, we closed out for 9.8. With Roblox at 50, those would currently be worth about $20 a piece, which would be a $13,000 loss. So by closing those, the difference between the 5,000 and the 13, one, we saved ourselves about $8,000, and two, with the preceding cash secured puts that we sold as we scaled back in, we've actually pulled together about $3,800 right there. So we actually, by cutting this position in half, being patient, and then scaling back in, yes, it sucked that we initially locked in a little bit of a loss, $4,800 right there, but you'll notice that the net effect between what these would have traded at and the subsequent profit we made off these is actually roughly a $13,000 difference. So one of those things where, yeah, we're losing on that position overall right now, but if we did anything along the way that saved us money, we consider that a win too. Money not lost is, kind of money made in my opinion. But that's where we're at right now. We have a 67.6 break-even price. We are a little ways away from that. But again, this is one that could definitely be managed on a week-to-week basis as we roll half the position out. And we still are holding on to that initial half for the 70 strike puts, but we'll see how those turn out. I imagine they'll probably get assigned pretty soon. And actually, let's take a look at the options chain here because I had an interesting idea that I was thinking of, and it's potentially these April are probably going to be assigned at some point soon. So we'll have 700 shares at a 66.2 basis, and then combined with whatever we're doing down here. So the idea that I was kind of having is saying, hey, let's just take these shares right now. That way we don't have to wait until April. And then, even if we go 2 weeks out, what kind of call premiums can we get for Roblox, right? If we wanted to sell something like a 55 strike put, that would still leave us a little bit of upside on the shares, but that would directly take $2 off of our break-even price, and all of a sudden that's down to 65. And again, we're not going to get back up to 65 because our gains would be capped at that covered call strike we write. But again, similarly with what we did with Palantir, you don't need to get it all back in 1 week. You keep chipping away. You look at DraftKings. You don't have to get it all back in 1 week. We were selling 22 covered calls when our break-even was around 26. But where did that get us eventually? It got us into a position where we now have a 22.48 break-even price on DraftKings, and we're much closer to breaking even in the short term. And that's exactly the same type of strategy we're going to have here. And it sucks because this thing's dropped 47% on us, so it's probably not going to be as immediate as we would like it to be. But again, no timeline on these trades. We've got all the time in the world, several really, really high price targets on Roblox, so definitely some good reason to be bullish and just hang on tight. So that covers these two. Facebook is another similar one to Affirm and Roblox, but after we got burned by Affirm and Roblox, we started this one out a little bit more intelligently, I would say, where we only sold one contract as opposed to getting in with the full 10 or 15 contracts off the bat right there. So that's what we've done. And we did this when Facebook was trading at about 240. Facebook closed Friday at, let's see, it's not even on my watch list. Let's put Facebook on the watch list. So it closed Friday at 210, right? And we got in on the trade when Facebook was at 240, like we said. It's down to 210, so it's really like a 10% plus drop on Facebook since we've entered. But still, remember, we sold these things for about $4 a share, so our break-even price is $196. So even with the 10% plus drop on Facebook, we still have another 6.88% cushion on this to take home that $400 of profit. And this is a really nice and easy, hands-off, just let it ride in the background. If it gets much higher, we could double down if we need to, but I'd rather take a little bit of risk off some of these positions before just, kind of increasing this one indiscriminately. DraftKings we talked about at the top of the stream a little bit. We sold more conservative covered calls, and that is just a result of wanting to aggressively drop that break-even price because we were worried about a drop in the market. And if you look at the futures that we have up here, /ES is going to be the S&P 500 futures. They're down 2.68%. I think as far as a drop on a Sunday night is concerned, this is probably the biggest drop that I've seen so far this year. So definitely expecting a little bit of a bloodbath in the market. And because of that, we were well prepared for it, right? We sold in the money covered calls. So DraftKings can drop all the way to, 21 this week. and then we're still not going to have any difference right there, right? This doesn't, oops, that's not what I meant to do. What did I just do? Okay, 21. There you go. It could drop to 21, and there's no difference, right? Because the 21 strike covered call absorbs all of those stock losses down to 21. So not really worried about anything there. Fubo, we were a little bit more, I don't know if I'd call that conservative at a 9 strike, but we definitely wanted to leave ourselves a little bit of upside there because Fubo's at the point now where it's basically trading at 1x price to, 1x sales to market cap, which is, a pretty good valuation. So that's one that I'm happy to leave a little bit more upside on. It tends to run a little bit more, so I want to give it a little bit of room to potentially get it back up to 9. But again, I was at least trying to get a little bit of premium to keep knocking this number down. And one that we have in the back of our mind is one that we could potentially double down on. And then the only other position that I have this week is Open Door. And this is the result of something that we tried to get cute with at the end of last week. We sold 8.5 strike puts at open on Open Door. And I can show you this chart, and you'll probably be able to see exactly what happened the second that this thing comes up. But let's see what we got here. Yes. So this one was really interesting because on Thursday afternoon, they reported earnings, and their earnings weren't terrible, right? They actually spiked all the way up to $12.24 at one point before coming back down to $9.50 and then settling right around 10 at market open on Friday. So we figured, the earnings report's behind. There's not going to be any big bombshell news that comes out. I was really surprised to see these big red candles on Friday morning. So when it looked like it was starting to settle down in the low 9s, I said, okay, maybe a little bit of after hours support at 868 here. Let's try to sell an 8.5 strike put and collect a little bit of premium. It was going to be almost a 2% ROR. I was thinking I was going to walk away with an easy $130 right here, but as we can see, it turned into a 570 loss. But the great part about these little Friday trades that you could so quickly turn around is how easily that we were able to manage it. And I could actually probably break this out really quickly here if I just duplicate this tab. We can call this one open trade breakout, and there we go. We do a little live profit tracking spreadsheet work right here. So we'll call this one open. It already exists because I have a different trade with open that I think is hidden right now. But for this trade individually, let's talk about this, right? We got in on this thing when it was trading at 910. We did that on Friday, which was 225. And now the end date's going to be 3/4. But let's close all these things out. Let's delete all these right here. Delete. And we sold 10 open 225 8.5 strike puts, and we sold those for 13 cents a premium. So following through with all this, we thought that we were going to get a nice little $130 to take home with us and have a nice little weekend with. However, as is typically the case, the stock market had different plans. It had a huge additional red candle right after that, and it bottomed out at 777. It looks right here at one point, which is very, very low. So what happened when open was trading at 7.77 is, look, the stock had dropped 14% additionally intraday. Yeah, and these things were trading for about 70 cents a piece. And we said, okay, 570 loss. This is a little bit risky here. And let me fill this out too, because our initial break-even price is going to be the 8.5 minus the 13 cents a premium. So intraday, as long as open didn't drop 8.02%, we were going to make $130 on the trade, which is, I think objectively a very, very good value proposition to hand yourself. So that is why we went in on that. And the capital that we invested is going to be, 837 times 10. So, if I put an equal sign there, it'll actually do the math for me. There you go, right? We had $8,300 tied up in this. And again, if this were max profit of 130, this was going to represent a 1.55% return on capital. And this really would have been kind of a one-day trade. And if you want to play the really stupid annualized return game for a one-day trade, that annualizes to a 27,000% return. And that's about as clickbaity as we are going to get. But what happens there is it didn't work out. It went to 777 at the low at one point on Friday afternoon, as we outlined. It had dropped 14% on us since we entered the trade. So it was an even greater loss on Open Door stock during that day, but a pretty significant drop just after we entered. And so these were trading for 0.7. We said, okay, here is the current situation. We have a $570 loss. We have an 837 break-even price. How can we roll this position in such a way that gets us, a little higher probability of profit? And the answer was rolling these down and out, as is so often the case, for the typical advice we like to give is to roll down and out for a credit. And we rolled down and out. So 3-4 was the expiry date. We rolled down to an 8 strike, meaning, open door only needed to be at 8 for us to make money. And we would typically like to roll for a credit, meaning we would want to sell these for more than 70 cents, which is the debit that we closed for. However, we were only able to roll for a debit. But why was I okay with rolling for a debit? And we opened these for 61 cents is what we opened them for. So we opened them for 61 cents, and you'll see that instead of a credit, we sold these for 9 cents less than we closed them for. So that's a 9-cent debit. So you might say, HT, why did you do this? You always say roll down and out for a credit. Why did you roll down and out for a debit? Because one, when you roll down and out for a credit, yes, the credit you get decreases your break-even price, but there's also a second part of that equation, and it's that the decrease in the strikes that you roll down and out to also is a direct decrease of your break-even price. So while our break-even price increased by 9 cents right here due to the debit, it decreased by 50 cents right here due to the change in strikes, meaning that there was a net decrease in our break-even price of 41 cents. So minus 0.41 theoretically should get us to a 796 break-even price. And if we put the formula in here to calculate the value of these at expiry, we are going to find that this math that I just worked backwards into, please work out. We're live right now. I don't know if this is going to work. Should work. There you go. It gets us to that zero total profit number, our break-even price. So now we're in a position where, hey, open doors at 777. It has dropped 14.60% on us. But by rolling for a small debit but rolling down to a different strike, we can get our break-even price from 837 to 796. And again, we did all of that on February 25th. So that's why I really, really like late in the week earnings trades, because one, they're typically pretty high probability, right? We started this trade when Open Door was trading at 9.1. We had a break-even price of 837 for what would have been like a 6 or 7 hour trade, which is a very, very high percentage. But, trades really go one of two ways. One, the high probability result, it stays above 837, which didn't happen. Or two, it goes down and we could manage the trade, move the goalposts, lower that break-even price for next week and try it again. And that's exactly what we did. So now we have a 796 break-even price headed into next week. So for Open Door, I think the best way to summarize what we did here is at roughly, 9:45, 9:50 in the morning, we saw a stock that was trading at 9:15. And we said, okay, I'd be happy to own this at 8:50. And all of a sudden, we took a stock that was trading at 9:15, and heading into next week, we now have a 9.76 break-even price. So we essentially gave ourselves a 12.53% cushion. And as you could probably see from when we've been flipping back and forth between Thinkorswim and the browser, it finished at 8.44, which is kind of a little bit of a slap in the face because these would have been worth 6 cents and we would have made money overall. Again, pointing to the effectiveness of an option selling strategy and the patience it allows you. But since we took the safe route, we now are in a position where if we put this in and pull in the open price, there you go. We're only going to make $40, which is less than the 130 that we originally set out for because, we have a 796 basis and the gain, so to speak, is capped at 8. But I'm okay with that because Open Door can go all the way back down to 8, and we're going to have found ourselves in a situation where a stock that we had a bullish position on dropped 12% in just 1 week, and we still made money. So that is the trade-off that I go for with that. And that's why I'm okay with, even though we initially had a 130 max profit, and now we've cut that down to only a 40 max profit, the fact that we can make any money at all on this, despite this big drop right here, is why we run the strategy we run. And it's why I really, really like those late in the week earnings trades, because one, they're high probability. Most of the time you're going to make money. And I think if you look at our trade performance on the year, these earnings trades that we've been opening, earnings, they're 5-0 on the year. They're very, very high probability. And again, another earnings one with SQ that made us more money. But what we've been kind of going for, and what happened with Open, is kind of post-earnings IV reversion, which means that if there's a big, big move in the stock after earnings, sometimes that big of a move will keep implied volatility temporarily high. And Overstock right here that we made 141 bucks on a couple weeks ago is a really, really good example, right? If you take a look at Overstock, you'll see they had this big move for earnings where it jumped from 35 up to 50 in the morning. And that actually allowed us to sell 40 strike puts. So we set up a trade where we knew that they had good earnings. The stock, rightfully so, had risen. And as long as it stayed above this number, we were going to make $100 and something. And that's exactly what happened, right? We comfortably cruised into the finish line on that one last week. And again, zooming out to the 20-day here to illustrate what's going on with implied volatility, right? Typically, after earnings, you'll see it drop off the face of the earth. However, when you see a really, really big move, it remains slightly elevated for a short period of time before then dropping and getting back to a more normal level of implied volatility. And what do we know about implied volatility? The higher the implied volatility, the higher the option premium. Therefore, consequently, the lower the implied volatility, the lower premium. And as this implied volatility drops off, that's great for us option sellers, and that is how we make our money. So that's the idea with these post-earnings IV reversion trades. And again, even if you're wrong, like we demonstrated with Open, and say Overstock, continued back down below this number, we just flip the position into next week. We lower our break-even price a couple more bucks, and then we try it again. Right? And that's how effective this thing is. And sometimes it might keep going down and this can turn into something that looks like this. But even if it does turn into something like this, as we've demonstrated, we can eventually get this trade to the promised land where we want it to be at break even. But yeah, I think that's a pretty good summary of what we've got lined up for the week. And again, I think one of the best ways to evaluate, is the position I'm in one that is going to be, sorry, I saw a little typo in here as I was going through. It should be an 8-strike put. But one of the best ways to evaluate what we're in on a week-to-week basis is, hey, if stocks didn't move, right? Because stocks can go up, stocks can go down. I always find for evaluation purposes, the most likely outcome is that the stock is just in the same exact place next week. So I think the best way to evaluate what we're holding for the coming week from a profitability perspective is how much money would we make if everything stayed dead flat. So we've already see that there with the 12-strike calls from Palantir. That's the premium we would get there. This is the premium we would get from Roblox. This would actually go down to 0. DraftKings, we would get this much premium. Facebook, whatever, I'm not going to adjust that. Fubo would get $460, and then these would expire worthless. So we're in a position where if stocks that we're holding just didn't move in the upcoming week, we would take home $4,810. And for me, I think that is objectively a very, very solid place to be headed into the week, right? Again, that'd be a pretty significant chunk back out of this loss, this hole that we've dug ourselves into. It'd be another little piece of progress towards outperforming the market on the year. And spoiler alert, if futures are down 2.6% right now, and we take a look at that, and this would be, probably roughly minus 10-ish% if you added that overnight loss. Right, we cross paths and we get on the good side of this chart, and we're now outperforming the S&P 500. But a lot of assumptions there. That's assuming that everything stays up or stays dead flat, and we already know that futures are red. So some of these are probably going to lose us a little bit of money on the stock side of things. So, I don't like to get too far ahead of myself, but I think it's just a good way to evaluate what you have for the coming week. And again, we're only using about half of our buying power right now, so we have a really, really attractive amount of money that we have on the sidelines. That was something we emphasized in the Discord server, that, hey, let's keep some cash on the sidelines. Let's, because the market went up a ton at the end of last week. And I kept saying, I don't know if I trust this big run up, right? Because it was just Thursday morning when the S&P 500 ETF SPY was down at 410, which is so low. And all of a sudden, you blink and you're trying to tell me that we're up at 440 like nothing ever happened. Like, that did not make a ton of sense to me. And there you go. You can kind of already see the drop off. This is interesting. I don't recall ever seeing this thing trade on Sunday nights, but you could already see the effect of this, right? We're back below all the gains that we made on Friday when we were up 2.21%. So I'm expecting to see a decent drop off Monday morning in the market. But with that drop off, right, is going to be opportunity for us. We want to put ourselves in positions where when the market falls, we're not someone who's worried about a margin call. We're someone who says, okay, I've got all this money ready. I'm going to start opening positions. So what positions are we going to open? This is the segue into the probably more interesting part of this, where we talk about what positions look good for the upcoming week. And I'm going to take a sip of water, and then we're going to get into that. We got a good question from Todd Miller in the YouTube chat asking, have we looked into futures for day trading? And actually, futures, I've looked into it a little bit. I'm eligible for futures trading, and it was one of those things that I thought would be helpful to have just in case there was some sort of super, unique situation where I needed to hedge overnight dramatically in case something happened. This Russia-Ukraine war with how many things are happening and how many moving pieces there are on a day-to-day basis is kind of starting to fit the bill as something like that. But I have been paper trading a little bit with ES and, just experimenting what that looks like, how that would protect us. Because if you had something like this, if you had a short set up on ES, even just one contract, you would have made about $5,000 just off this drop. So I think might be a very, very effective way to hedge overnight. But as far as day trading itself, I think one of the things that I love about this strategy so much is how hands-off it is, right? We have all these trades that we've set up for the upcoming week. We set them. It takes, a few minutes to set these up. We do it Friday afternoons. We roll positions. And then, we keep an eye on the market during the week. We have some alerts set up where if something looks good, we're free to jump in. But I could do absolutely nothing. I don't even need to open my brokerage app for the next 5 days. But with that said, we could still have this kind of return with zero work. So day trading is something I try to stay away from a little bit. One, because I have a full-time job and just quite frankly can't put that effort in to be glued in front of the screen. And two, I think one of the big values of what we do is the fact that you don't need to be glued to a screen to run the strategies that we run. But I think I've looked into futures trading for sure as a little bit of a hedge potentially. But as far as day trading, I think I've stayed away from that a little bit. But let's talk about what we want to do for the upcoming week in the market. And we could, do our little scanner where we pull in the high ROR puts that don't have earnings. So we've objectively identified the highest returning puts in the market. I'm sure we're going to have some big time stuff here. Yeah, IRNT, some really SKLZ. I can't believe this thing is down at 3 already, Let's actually pull this one up and see what it looks like. If I can get this to load. Come on, SKLZ. And, one of these that has weekly options, some really, really good premiums. Where did this thing bottom out? Okay, it bottomed out at 178 after they had earnings. So there is some palpable downside here. I don't know what exactly got announced, but there is some very, very aggressive looking candles back on the 24th. Let's see what we got right here. Oh, we've got price targets adjusted to 750. So, banks are keeping an outperform rating on it. It looks like they had, lower, yikes. They missed on estimates and they projected sales to be 400 million as opposed to 548, which is what they originally expected. So that doesn't look very good, but also, the price action in the stock, I think fits the bill there, right? It not only has it dropped from 5 down to below 2 at one point, but it also was at 36 a year ago and is now down at 3. So you're kind of bottom of the barrel here. Decent amount of premium, right? If even the 2.5 strike puts offer a 1.83%, and this might be some of the worst advice I ever give, but sometimes in super, super crazy market conditions like this, it's the crappy little stocks like this that can kind of provide you a bit of a safer haven, right? Because if you have something like Apple and you wanted to target a 1% ROR, you'd have to scroll up. You can't even sell an out of the money put on Apple that gives you a 1% ROR. However, if you look at something like SKLZ, like we just had up, and you could sell a 2.5 strike put for 1.83% ROR. And again, that's a 2.5 strike with this stock trading at 307. Let's get our trusty calculator back up here on screen. Come on. So we know that a 2.5 strike put, if we sell that for 4-ish cents of premium, that gives you a 246 break-even price, which below the current price of 3.07 is a 61 cent cushion. And that 61 cent cushion as a percentage of the current price, 307, is a 19.8% break-even price. So the point I'm trying to make here is if the market drops 3% in a day, which is a very significant move, these Apple strikes that we looked at previously are going to get blown out. However, if the market drops 3%, SKLZ probably isn't going to drop 20% just because the market drops 3%. So these really, really big cushions that, a volatile market environment offers you can be very, very helpful. And I think the king of the big cushions on crappy stocks right now is Wish. Funny enough, right? This thing bottomed out at 183, but even over the entirety of this move that you're looking at right here, right? We've got red lines doing a little bit of analysis from back when this thing was trading at 8. And I think we've kind of played this most of the way down, and every single trade that we've made on Wish has been profitable, right? And we jumped in on this idea that we're talking about here, right? We're not just talking out of our ass. We've been putting our money where our mouth is, right? We sold 2 strike puts last week, and that was a week where the market, even though it ended up 0.81%, things got pretty messy at one point. Remember, we look Thursday morning, the S&P 500 ETF got down to 410, which is a huge, huge drop. And if you look at Wish, it only got down to 1.8. And even after that, it immediately sprung back up to 2. So these areas, are really, really decent areas of support. There's a lot of kind of social media interest in the stock as well, which might keep it a little bit propped up. But again, you could sell something like a 2 strike for 9 cents a premium, which gets you 4.71% ROR on a weekly basis. That's huge. I think Wish might have earnings this week. Okay, yeah, they have earnings on March 1st. So ignore everything I'm saying about Wish right now, but point stands with something like SKLZ. And even, the prior week, you saw what we did with Wish, where we got, 8 cents of premium on that similarly. So just because they have earnings this week doesn't mean that this is the only time that they have premium, right? We demonstrated last week that there was a decent amount of premium on Wish. So that opportunity is still probably going to be there at some point in the future, but things like skills, you could go to the scan really and even put some sort of price filter on a lot of these stocks, right? There you go. You see a 6 strike put on Tilray, which means if you pull Tilray up, another really low priced stock with a decent amount of volatility, meaning you could go all the way down to 5.5 here. You could go down to 5 and get just under 1% ROR. There you go. But another example where even when it had that really, really big drop in the market on Thursday morning, it didn't get too far below 5.5. There's decent support at that level, and especially considering, right, 10 cents a premium would get you a 540 break even. Really, really big cushions on here on some of these smaller, more volatile stocks. Now, with that in mind, these are smaller, more volatile stocks. Don't go putting 80% of your portfolio into these. But if you have buying power, I think this is a really, really decent place to start, especially targeting some of these higher ROR ones. Maybe pick out 3-4 different ones down here. Our good buddy Fubo is in the mix here at an 8 strike put, but maybe get something like SKLZ, maybe TLRY. Looks like Newegg is offering some decent premiums as well. Right? You can get 2.56% ROR on a 5 strike put, and that's a stock trading at 570. That's an over 10% cushion, and that's a level below where it reached on last Thursday morning when things were looking really, really bloody. And keep some of these in the back of your mind, right? Because these prices we're looking at right now, they're going to be a lot lower. Futures are down 2.64% right now. That is significant. We are going to see probably a move that looks similar to what we saw last Thursday morning. I imagine a lot of what we're looking at right now is going to be significantly better. So any strikes that we're talking about right now, maybe aim a strike or two lower on Monday morning when you crack open that brokerage account. But those are a few good ideas, right? That's that basic high ROR put scan. One thing that I think is really, really advantageous to look at in times of, uncertainty in the markets and high volatility are earnings, right? Because we remember that earnings are a great place to look for option sellers because, one, if there's no implied volatility in the market, there's going to be implied volatility on stocks that are announcing earnings just inherently by the nature of what that creates. So those are always a good place to look. But even when there's high volatility in the market, high overall market volatility plus volatility from earnings creates some obnoxiously large cushions. So what we can do here is pull up our Discord server really quickly. Let's sign in right here. It's taking a sec to load earlier, so I'm hoping live on the stream it behaves a little bit better. And again, if you're watching the stream right now and you want to be in our premium channels that we've got here in the Discord server, hourglass-trader.com, or come join our Discord server. We've got links to do that We've got a lot more activity in the premium channels as opposed to the main channels. But again, you could get the link to sign up for it here. Free week for anyone that signs up for the monthly, so you have plenty of time to decide if it's for you with no financial obligation. But let's get into the good stuff that we want to talk about. How are you going to make that money to pay for HT Premium? And here's the handy dandy graphic that we like to look at on a week-to-week basis. A lot of big-time names reporting earnings next week, right? We've got Zoom, we've got SoFi, AMC, we've got PaySafe is a big-ish name just because they have fallen off the face of the earth. Let's see what else we've got. We've got Snowflake, ChargePoint, Okta, Costco. And again, we really like we mentioned a little bit earlier in the stream, some of these back end of the week trades just because how quickly you could flip them, like what we did with Open Door. But I think the interesting names definitely skew to the front end of the week with Zoom, SoFi. So let's take a look at some of those things, right? Let's take a look at SoFi in particular because that's the one that definitely piques my interest because we played that one last week with the 10 strike put and it worked great. So what do we like to look at when we look at earnings, right? This yellow number MMM right here is market maker move. This is a proprietary formula from TD Ameritrade that kind of uses some option metrics to calculate what you could expect that move to look like. So at plus minus $1.70, that implies that the bottom end of the expected range for SoFi's earnings is going to be around $9 a share. So let me take off all these old drawings that we had, remove drawing. Here we go. That implies that the downside is to about 9. And from your initial look at this, I'm a little bit skeptical of that if I remove this one as well. Because just last Thursday, which is one of those points where how bad can the market get? Just look at where stocks were last Thursday morning. That should probably be your picture of downside for a stock. But we see SoFi got all the way down to 845 at one point, which is super, super low. Did it bounce back? Absolutely. But let's zoom the chart out a little bit. For starters, great place to be from a long-term perspective. SoFi was a former SPAC, and we've seen several former SPACs get back down below that $10 net asset value points. There's definitely some palpable downside here. However, SoFi is a little bit more, a stronger company as opposed to some of the other companies that I've seen taken public via the SPAC method. But now let's get to the good stuff and let's see how far down we could go and still get that 1% ROR number that we like to target. And it looks like the answer is 8 strike, which is, I think a decent value proposition, right? This right here is the low end of the range. 845, which falls below that, is kind of that Thursday morning disaster scenario. But again, that 1% RR comes all the way down here at 8. So you have an even bigger cushion right there. So this is one where I don't think 8 strike puts are a bad idea. But similarly with what we talked about earlier in the stream, how position sizing works and how effective doubling down can be when things go poorly, definitely one that I would maybe start with half-sized position, because if you start with the half-sized position and get assigned these shares, you would be the proud owner of SoFi at about $7.90 a piece, which objectively, we pop back to that chart that we were just looking at. $7.90 is a great price to own this stock at. However, things can always get worse. That is what we want to have in the back of our mind as we trade in this kind of a market. Things can always get worse. So with that said, leave a little bit of money in your back pocket so you could potentially average down on this one. Because I think anything below 8 is a good price to have it at. But if it has something catastrophic happen, right? We've seen some very catastrophic earnings results. Don't let yourself get crushed by that. But again, the combination of big time volatility in the market and volatility from earnings lets you set up a trade on SoFi where you have a $2.70 cushion roughly on this stock for the upcoming week, which is, a full dollar below that market maker move. And we can compare that to the expected move too as well, which is only $1.92. So definitely outside of that range. I think the numbers work out really nicely here. It's a 1.33% ROR. I might pull the trigger on that one on Monday morning. I got to be honest. But the other thing with earnings as well is that typically if you're playing earnings, you want to be playing earnings, right? You don't want to open it Monday morning or Tuesday morning and have all this price risk between Monday morning and Tuesday afternoon. So for earnings, I like to wait until the last second before earnings, and that's going to be Tuesday afternoon. So Tuesday afternoon, throw that on your notes, throw it on the watch list, throw it on whatever you need to throw it onto. I think SoFi selling puts in that 8 strike range is going to be a very solid opportunity. The other what other bigger names do we have on here? Maybe we talked about Wish. There's some really, really big downside cushion on some of those 1.5 strike puts that we looked at a minute ago. But this company is not doing well, and I don't want to play earnings on companies that are just not doing well. So I think that would keep me out. Lucid, I think this is actually a really good short opportunity. Trading at 26.35, the company really has not sold a ton of cars yet. They've been pre-revenue for majority of the time that they've been trading, and have been trading primarily based off hype, and they have a really, really big market cap. And if we look at what has happened in the market to companies that do not have a lot of revenue to back up the numbers that they present, they have gotten slaughtered in the market, right? Let's take a look at Affirm. Unfortunately, we are the victim of this. Look at that big red candle, the continuation downwards after that. Take a look at Roblox, the big red candle and the continuation after that. And it's not even so much that these companies didn't have solid revenues, because they did have solid revenues. But the issue with these is that their valuations were just a little bit too high. And Lucid, I think, is a great combination of something that has a valuation that's too high and a complete lack of revenue. So an interesting trade that I think for Lucid earnings would be a bearish call credit spread, right? And this is one that we've seen this thing run from 15 to 61 off nothing but just hype. So not one that I would want to have anything naked on from a short position perspective. So a credit spread is a great way to manage that. Maybe just go at the money right here, a 26 short leg, extend that out to 28 so we're not pinching pennies here. And there you go. You set yourself up with the trade that has a little bit under 50% return, but definitely is directionally dependent on it going down. You could go maybe a little bit further out of the money to something like a 30. We could make that $2 wide. Oops. We could make that $2 wide again and see what kind of return that gives us. That's 340 divided by 1660 is a little under. It's about 25%-ish. Not the greatest for the potential risk there. But, we will revisit this one Monday afternoon because, again, they report Monday afternoon. We want to wait till last second to make sure that we are purely playing earnings. But that is one that I think it should definitely be on the radar from a bearish perspective for the upcoming week. Outside of that, nothing too crazy popping off the list here. But let's go back to our option scanner. Right, because our regular high ROR put scan excludes ones with earnings. But let's go to our scanner that has with earnings. And again, you could get all of these. You see we've got tons of these in here that we have preloaded that we use to help us find our trades. You can get all of those on our website, hourglass-trader.com. So let's run this one with earnings in the upcoming week. And I think this one may actually... be a little bit too far away. Let's do 8 bars because that means 8 days. And it looks like we have, this cannot be right. What have I done wrong here? I have some absurd out of the money scan right here. Okay. Let me make this at least, it needs to be, bear with me. It needs to be at least 0.01 to make sure we're getting ones that are out of the money. Let's scan again, and hopefully this number comes down from 555. There we go, 383 out of the money puts with earnings in the next week. So I think my favorite way to look at this actually, because the reason that we're looking at earnings in high implied volatility environments is because we want to get a really, really big cushion. And while probably the biggest ROR will give you the biggest cushion, a really easy way to actually just get right to it is to get the percent out of the money result in here. And you can do that by going to that settings cog, percent out of the money, add that item, click OK. And it would appear that I've clicked percent in the money. Live production, very tough right here. I would have edited that out in a YouTube video. Percent out of the money. There we go, there we go, there we go. So we have that metric right there. Let's sort highest to lowest. This is just completely useless 300 right there. That is just very incorrect. A lot of zero bids here. That's kind of irrelevant for what we're doing. But it looks like we have some bid activity on IQ, which is 61% out of the money. Is that something that's remotely a possibility here for us? Let's get out of these spreads back to single. And, it kind of looks like it, right? There's decent amount of volume, right? 256 of these traded on Friday. There is a tight bid ask. I mean, it's 1 cent wide. That gets you 1% ROR. And if we look at the chart here, the low is 326. Yeah, they're about to present earnings, but 250 seems pretty low. I don't know anything about this company. But numbers wise, that doesn't look too bad. Chinese company. Okay, there we go. No. So back to the scanner. We've got IQ. We've got DDD. That's a zero bid one right there. Maybe let's just look at it to see what it looks like. Came up on the scanner. Let's take a peek. Another one with kind of wider. This is kind of interesting because there's definitely some volume on that 10 and 11 strike, but I don't think anything that we really would be able to get filled effectively. Looks like Ride and ARVL are going to be the next couple over here. Let's see what ARVL is looking like. Since it's a two-strike put that popped out, I can't imagine it's doing too well. There we go. So they've got earnings coming up. Looks like the low on them is 291. If we go down to 250, we could get, a 5.26% ROR. That's pretty big. Pretty big. And again, that MMM right there is 74 cents, putting the low end of the range pretty much right at 250. 250 with like a 12 strike, with like a 12-cent credit right there would get you a 238 break even. That's not too bad. But again, this is a former SPAC. This is a company that I think is pre-revenue. Let's remember what happened to Skills. I mean, just because something's trading in the threes doesn't mean that 250 is safe all of a sudden. Now, did it get back above 250? Yes, but if that big red candle comes, let's wait for the big red candle and then, and then jump in after the damage has been done. But let's see, ATER, let's take a look at that one. Yeah, we've got Electro making a good suggestion in the Twitch chat, putting a filter on bid for at least 1 cent. And I've got that on my without earnings one. I think I just got lazy on this one. I'll definitely have to update that. What were we looking at? ATER. Holy hell, this looks like something that is going to offer a ton of premium. Implied volatility has fallen off a little bit, as you can see right here. But let's take a look at what the options chain is looking like. You can get 1%. I mean, zero bid on it, but there is volume, so they were trading at something. I just don't know. Don't really know what. But yeah, it doesn't look terribly promising. So probably would leave that one alone. That leaves us with, maybe the more respectable company here, Zoom, which gives you a 52%. Is this right? A 52% out of the money here on an 82 strike, putting a 1% ROR. I mean, it looks like that might, it's not 50% out of the money. I don't really know how it calculated that, but maybe it calculates it as 50% higher than the strike, gets you back to the current price. Whatever. Regardless, we can see that down here at an 81 strike, you get 1% ROR. This has a $22 MMM. Here's the deal. I don't like Zoom, the company. I don't think it's great. I think they're on the way out. I think the pandemic was kind of peak bull case for their business, and we're out of that, so it's going to be headed back down. One thing that I do want to check really quickly is the 3-year chart to try to ascertain where this thing could potentially stop. And it looks like it peaked in 2019 around, 100-ish. So not bad. I mean, at the very least, with everything that's happening as far as brand, if you put any stake in brand value, surely Zoom in 2022 is worth more than it was in 2019. So that is when it topped out at around 100. I love this trade. I got to be honest. I don't like Zoom, the company, but sometimes the numbers just look too damn good. And one thing about this is I'm sure there's a really decent amount of maybe 20-ish, 30-ish% margin privileges right there. So multiply that number by 3. You get a 3% return on capital right there. But again, super, super, super far out of the money. So if we get our handy calculator right here again. Come on, computer, load for me. There we go. 125.32 is the current price. Let's just use 80 as a flat number. That gives you a $45 cushion, which as a percentage of the closing price on Friday of 125.32 is a 36% cushion. So in plain English, as long as Zoom doesn't drop 36% on earnings, you're going to make money. And again, we can't talk enough about, from analysis perspective, about these red futures right here. The bigger this red number gets, the better these premiums are going to look. But again, MMM 22, that puts the low end of the range at 103. And again, you could double that MMM. It could go twice the expected move. That would still stick you above 80. You'd still be above 80. And I think that's a really, really good place to be for this earnings trade. So I'm a big fan of selling an 80 strike put on Zoom and just playing earnings. And their earnings, as Todd I think just pointed out, are going to come tomorrow afternoon. So we're going to want to open this trade tomorrow right before close. And there's probably going to be a ton of blood in the streets in the market. Going to be a lot of red in the market tomorrow, but you could rest easy knowing that with that buying power you saved up over the weekend, you've got a really nice cushion on a company that traded around levels you could potentially be assigned at back in 2019 when theoretically it should be worth a little bit less than what it's worth right now. So I really like that one. The numbers work out very well right there. And again, this kind of gets back into the idea of the quote-unquote round trip trade that we like to talk about that we've seen so often. Square is a great example, right? You go to the 3-year chart here, had this huge bull run and it starts coming back down. When's it going to stop? The answer is typically right around the peaks of where it was before the COVID crash. And again, we drew the lines in there, and those lines were very perceptive because it pretty much bounced off of this red line. And that is why we do this analysis, right? Another good example, what had another good example of this? Maybe Etsy was one that was kind of like that. It was coming back down. And again, you see it started to bounce off a little bit of support here. Didn't quite get this far down. That's why we stayed away from Etsy for earnings. But again, Zoom, if it completes this round trip trade, there you have it. The peaks pre-COVID are going to be in the low 100s, and an 80 strike is plenty of cushion there. Another interesting one for the upcoming week is Beyond, because this was offering a ton of premium. They had earnings last week, and implied volatility is still a little bit elevated as compared to where it's historically been. So we can take a look at that, see if there's anything appetizing for the upcoming week. You can get 1% ROR down at 39, but again, this thing last Thursday was at 41, so I don't even know if 39 is as big of a cushion as I would like. However, little caveat again that it definitely could be a little bit better if we look tomorrow morning at these, because this price is going to be lower. But again, let's go to what I think has been the most useful for me personally on these scanners, and it's something I'm about to make a video about soon. Go back to that standard high ROR puts with earnings, and I feel like every time I say ROR, I do a terrible job enunciating the individual letters. High ROR. The intersect with feature right here is something I really like. And we can intersect this with, because we've got stock scans, right, which could pull up some interesting things, right? We have a good stock scan that I like to use called IV Rank Scanner right here. And it just pulls up companies that have IV at like an all-time high, basically. So if you sort this high to low, and let me show all the results here. Let's go to 500 results here. Scan that again. And I want this to be in descending. Well, whatever. It did what I wanted. We have IV percentile really high right here, right? So we could pull up any of these. And we know a lot of IV percentile is high sometimes because of earnings. So we could see that with some of these little, these little icons that you have right here. But how about something like Foot Locker? Foot Locker IV is really high right now. If we go to FL, we go to the 1 year. Wow, there you go. There's your answer. It's one of these post-earnings, huge drop-offs. But the great part about this, right, you see this rise in implied volatility up to earnings. We look at historical earnings periods, right? Here's an earnings period right here. Big drop, but IV dropped off a cliff right after. We see another one right here, the earnings icons. Implied volatility runs up and then drops off a cliff. We have not seen the drop-off yet here, so there's a little bit of residual implied volatility on this. And I don't really know what happened with Foot Locker earnings, but holy hell, this thing is way down. Price target cut to 33. That is pretty low right there. Evercore cut the price target to 33. But again, 33 again, that's above where the current price is. But the thing with these option sales that we can, facilitate is that we can get a much better break-even price. So let's see what we can look at from an ROR perspective. And unfortunately, they're 5 wide right here. They're 5 wide, so we can only go down to, I guess we can go out to March, but this doesn't really look that advantageous for me right here. But again, one of these where it's a great combination of RSI being at the very bottom and IV being at the very top. That is what we like to look for in option selling types trades. However, just not enough here at this strike, unfortunately, to justify it for me. Maybe we could, let's see. I mean, really, really decent margin privileges, no doubt about that. If this maybe gets up to 20, 25 cents at some point this week, I think that could be a really, really good opportunity. But as of how it sits right now, not for me. And again, we've got this RSI column in here as well to help evaluate that as well. We could sort low to high. There you go. Foot Locker is right at the top of the list. We could look at something like VRT. I have no idea what this thing is, but implied volatility is high. RSI is low. Let's look at VRT. And there you go. You have another earnings casualty, and it looks like a very, very similar theme for what we're seeing. And can you get any premium on these? I mean, there's really not any volume on them, period. So nothing too crazy. But getting back to the point that I was trying to get at when we first brought this stock scan up is, hey, we've got this stock scan, that gives us a pretty decent list of trade ideas to begin with. But how can we cut this down, right? We looked at Foot Locker. The premium on those options wasn't as high as we wanted. We looked at VRT a second ago. The options weren't as great as we wanted. The answer is that you use a scan like our high ROR puts with earnings scan that brings up options that we like, and then we intersect it with the stock scan. So we go to personal. We bring in our our IV rank scanner. That's what we were using, right? IV rank. And now we scan. And now our results, instead of just getting a ton of, actually, I need to make this, high ROR without earnings, and then intersect it with that IV rank scanner. So now instead of just some catch-all list of a ton of stocks that just have a ton of premium, we're now looking at stocks with a ton of premium that also come from this list of high implied volatility. So this is where you start to get some interesting stocks that come up here, right? SOXL. I think we've had that one called out by a few people asking about it in the Discord server. It's a 3X ETF. I hate leveraged ETFs for option selling. I do not care how big of a cushion you get. And you can get a really, really big cushion, right? You can get down to 31, 32 and get that ROR that we like to look for. Do you get any margin help? Not really, and that's for good reason. But you can get down to 31 here and sell a put for the upcoming week. But again, 3X leveraged ETFs, not the best, right? We try to make some smart trades. That's not a smart trade. But Netflix, right? Netflix comes up on here as something that is high in IV and high in option premium. So there you go. You'll see IV is relatively, let's go to this 1 year chart. IV rank is 70, IV percentile 88, and kind of spells out in plain English what that means right there. But again, I don't know. You could see a pretty clear base at 350 forming. IV down here on the charts elevated. RSI isn't as low as we would maybe liked if we try to enter into something that was oversold. But which brings me back to another point. Let's intersect it with HT oversold stocks. There we go. Now we've got things that are oversold. So we know if we look at something, the entry is going to be very, very solid. So we have RSX and YNDX on here. Let's look at RSX. What is it? It is a Russian ETF. I am just not at all surprised by that. But again, with this scan, we have identified something very, very quickly that has some fundamentals that we really like to look for in an option selling trade, right? We have something where implied volatility is run very, very high. IV rank is at 100, and we have something where our RSI is very, very low. I mean, it's kind of begging for a bounce, and there is a ton of volume on these. And this is something else right here. If you wanted to get a little bit risky, this is the place to go, because I hesitate to, fully recommend this because it's a Russian ETF and they're about to be cut off from everything. So the downside risk is insane. And I imagine these premiums are going to look even better come tomorrow morning. But these are some decent numbers. And I'm sure you probably can't use leverage at all here. That's correct. But might not be a bad place if you want to throw a flyer out there, because, how bad can things really get? Like, short of Russia dropping nukes, where I don't think the stock market is a concern at all if nukes are flying around. They're in war with Ukraine. I doubt they're going to keep pushing into NATO-controlled territories. All of the heaviest sanctions, such as cutting Russia off from SWIFT, have happened over the weekend. I think the damage on Russia is going to be realized tomorrow morning. Their stock market is closed, I think, tomorrow, or at least operating on strange hours. So we may not see the full effect tomorrow morning, but we are probably going to see a very substantial gap down here, which is going to put some serious premiums into these. And if you could get in on something in this, 5, 6, 7 range and maybe get 1% ROR there, I don't care how bad of a situation Russia is in. I think that is a very, very good place to be, because if you look at, this is crazy. Even if it went all the way down here, there's $1 premium at the money for calls. So we think about these trades, maybe not in 1 week, but what would the second week of the trade look like if it did continue to go down? If you got 1% ROR right around here at like a 7 strike, you'd have a 630 basis and then could sell covered calls. But also another very good point by Electro is that the ETF could always go out of business or get halted, things like that. It is very risky. However, I don't know a ton about it, which is why this is definitely not an official recommendation. But I think maybe just a fun one to look at Monday morning to see what happens right there. But again, on the scan, the other things that come up, there's one other stock. It's YNDX. What is YNDX? Yandex. And what is Yandex? The answer is I have no idea. So let's go to the Analyze tab. Let's go to Fundamentals. Let's type in YNDX. And it's communication services. They don't really give you anything here about it. There's normally a little company overview. Let's look at the live news. They just had earnings. Let's see. Russian tech sector could... Okay, there you go. Russian tech. This is another Russia-related stock. And as a result, the put premiums are, quite frankly, enormous. But yeah, definitely in the same realm of risk. But even though we have nothing super, super juicy to look at right now, this is kind of the line of thinking that we want to follow when we try to look for some of these trades, right? So I think this is a great place. And I think I'll try to maybe we've got in our Discord server, we have some channels where we have bots that alert us when there are certain situations coming up and certain of our scanners get options on them. And I think this might be an interesting one, pending feedback from the group if you guys think it might be useful for something like this, because it's kind of a very specialized little, very, very narrowly targeted search. And we know that when RSI gets low enough, things are begging to bounce, right? Every time this gets blue, big bounce right there. It gets in the blue, at least a little bit of a short-term bounce to flat trading, and flat trading is all we need to make money when we're selling options. But that is kind of how you use that intersect feature. And I really, really like this scan. I might keep that up. So intersect with oversold or intersect with high IV rank stocks. But again, this is kind of a little bit redundant because when IV is high, option premium is going to be high. So intersecting a high option premium scan with a high IV rank scan is a little bit redundant. But intersecting a high option premium scan with an oversold stock scan, targeting stocks with high premium and stocks that are good for entry from an RSI perspective, now you're talking, you've got a much more concentrated, focused scan, which spits out 2 options for you, literally 2 options. As opposed to when you just have this one scan and it brings home roughly, let's see what the number is right here, 903 options. So this is a great way, this intersect with feature, a great way to parse through some of these trades to look for more specific situations from a stock perspective. And that's what we're using it with, and I'll try to set up some alerts for that one because I definitely think it's interesting to keep an eye on throughout the day. But let's see, we've been going for about an hour and a half. That's what we've got. A couple decent ideas from an earnings perspective for the upcoming week. I don't hate the idea of going with some crappier stocks like SKLZ to get a little bit bigger cushion in these shakier market conditions. But this is what we got for the upcoming week right here. It's going to make me scroll back down. Scroll. Come on. Some nice dead air here as I scroll. But there you go. We had a really, really good week last week. We made 17K. That's not to lose sight of the fact that we lost 20 the week before it, and we still have a little bit of a hole to dig ourselves out of. But hey, I think we're in a solid position to make some money back this upcoming week. We already know the market is going to be off to a rough start on tomorrow morning when things open up. So we're kind of be working against it. And again, when the market is that red, the goal is just to tread water, break even. And when the market is this low, you see a day where there's a 2% plus drop in the market, open a position. You should be looking to buy when the market is down like this. And when the market has a day like it had on Friday, close positions, free buying power up, because there is a ton of uncertainty in the market right now. Even just looking at the past 20 trading days. I mean, this is some of the, I wouldn't even call it chop, right? Like this is kind of chop where it's moving back and forth. These are just downright insane swings from a 1-year perspective. Some enormous candles, some ups, some downs. You need to conserve buying power, lock profit in, free buying power up when stocks are green, and look to be a, I'd say buyer because we're selling options. So look to be a position opener when the market is red. And that is how we are going to find success in these markets. Find situations like earnings trades that we've outlined a little bit earlier in the stream that give you the biggest cushion you could possibly get, because the bigger the cushion, the higher percentage probability of profit, and that is how we're going to ride out these uncertain times in the market. So again, we're trailing the S&P 500 a little bit right now. Where are we? This tab right here. There you go. We're still trailing a little bit, and this is with that hypothetical profit from this week. So really, we're at this dot right here. We're trailing a little bit, but all things considered, right? We've held Roblox, we've held Affirm, we've held Palantir and DraftKings. We have gotten slammed. I think if you averaged out the percent move on the stocks we're holding, it's between 40 and 50%. So what has happened to us is the equivalent of just an all-out market meltdown. And the fact that we are down less than 10% on the year right now, I think there's really something to say for that. And we're going to keep hanging in there, and stocks are going to eventually go the way that we want them to, right? And we could always play that fun hypothetical game of, what if a firm makes a run back up to 50 and these expire worthless? All of a sudden, if it loads and calculates for me, all of a sudden we're profitable on the year. If a firm just bounces to 50, and let alone if Roblox bounces back to 60 or something like that, all of a sudden we've got a 5% return. It doesn't take a lot to get us back where we need to go. We just need to make sure that in the meantime we appropriately manage our risk, and that is what it's all about. So an hour 50 in, or an hour and a half in, we are going to cut it off there. If you were still tuned in and stayed with us this whole time, thank you for tuning in. Come join our Discord server if you're not a part of that, because there's only so much that we could game plan for at the front end of a week on a Sunday night. So much happens on a day-to-day basis in the market, and that really has not rang more true than it has over the past few weeks with all these war-related stock market movements. The Fed is still considering raising rates in March, so that's something that's around the corner as well. I definitely don't think we are anywhere near out of the woods yet as far as the downturn in the market has been concerned. So if you want to join our Discord server, hourglass-trader.com, the link to join should be on the front page right there. And I think that's kind of all I got for this week. Let's hope we got another good week. We've been up and down this year, a lot more downs than up so far, but we're hanging in there, less than a 10% loss. And again, at the end of the day, we could lose money in a year, but as long as we outperform, I think we've done our job. So that is the goal right now. We have so many months ahead of us. In February alone, we had a 12.66% return despite the market being red. I cannot imagine how good our return in March, April, May, or June might be if the market is just green, right? So that is what we're loading up for. We've got our positions. We've worked our break-even prices down, and hopefully the fruits of our labor will be harvested at some point in the coming months. So just stick with it, stay patient, and the money will come. It's not a one-day strategy. It's not a 1 week. It's not a 1 month strategy. It's a long-term strategy, and stretches like this are just part of the reality of trading. So for those of you who have hung in there, I think everyone's done a really, really good job so far. I know we've got a couple people in the Discord who are even break-even because they didn't get in on the Roblox or Affirm trades. But hang in there, and we are going to be on top sooner rather than later, right? We were off to a pretty good head start because last year we were up 110%. So, still relatively speaking, we're doing pretty good. But this is all part of the game. We're sticking to the strategy that we've outlined. I'm really, really happy with what we're currently holding. If there's something you're not happy with holding, get rid of it. Don't fall victim to the sunk cost fallacy. But hopefully Monday morning things don't look terrible. We're going to open a few more positions based off what we talked about, and hopefully when we're talking to you at this time next week, we are looking at a green number right here. So for those of you who are still on, thank you for tuning in. For those of you who are still following us, thank you for following us, sticking with us. And that is all we've got for tonight. So until next time, this has been the Hourglass Trader, where as time passes, we make money. Thanks for tuning in, and hopefully we will see you guys again next week, same time, with more money in your account than you have right now. Thanks, guys.